Q4FY22 earnings conference call of CarTrade Tech Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Vinod Sanghi, Chairman, Managing Director and CEO, CarTrade Tech Limited. Thank you, and over to you, sir.
Thank you, Margaret, and I'd like to welcome all of you to the CarTrade Tech quarterly investor presentation. Thank you for taking the time out and spending time with us to understand the progress and the plans of the company. We have uploaded a presentation, and although I'm going to refer to it, I'll also speak out some of the numbers for people who may not have seen it or may not have downloaded or have it with them at this point of time. Really on slide 2, or page 2, what we're covering is the industry overview. What I want to talk about is the industry over the last few years first. If you look at the left, and then so with the passenger vehicle sales right from 2016-17 to 2021-22, as you can see, it's almost been flat. 3 million cars were sold in 2016-17, and 3 million cars have been sold in 2021-22. It's had its small ups and downs during this period, but the industry has mostly been flat over the last 5 to 6 years. If you look at the two-wheeler industry, it's actually over the last 5 to 6 years degrown. I mean, we've seen almost a 10 to 15% degrowth from 16-17, which was 17 million to 13.5 million in 21-22. So it's been a challenging time in the last few years with the auto industry. There are many reasons why that might have happened. Sometimes, there has been COVID in between, the BS6 norms got implemented, demonetization, multiple factors, but the reality is you've seen the industry over the last 5 years has mostly been flat to down. If you look at slide 3 and you look at the company performances in the last year, it gives me great pleasure to tell you that we've grown in spite of the tailwinds in the industry with supply constraints due to semiconductor issues, etc. The company has grown by 28%, and the Ebitda has grown by about 25% as well. We are the number one two-wheeler and car portal in the country. We are across now 160 locations. That includes our auto malls in 113 locations and 47 ABSHOR outlets now. I will talk about ABSHOR a little later as well. We have listed for auction our highest ever numbers of 1.2 million vehicles last year. 30 million customers visit our consumer platforms. What's more remarkable than 30 million unique visitors visit our platforms every month is also the fact that 84% of them come organically. And that shows the brand affinity and strength in the brand and the leadership in the brand, which our platform, the consumer platforms, Carwale, CarTrade, and Bikewale have. Our revenue is the highest ever we've achieved in the last year and in the last quarter. Our last quarter revenues hit at 106 crores or 101,000 or a billion rupees, but 106 crores is the way to look at it, which is given an annualized rate of 423 crores. Our Ebitda last quarter was 32 crores, which has given us an adjusted Ebitda run rate of 127 crores. Our Ebitda margin is come to 21% in Q4, and 21% is after excluding our other income. If we add our other income, it goes to 31%. So we've given you both the numbers, the Ebitda margin without other income, which is 21%, and if you include other income, which is the interest income or treasury earnings, it goes to 31%. Our adjusted PAT or profit after tax, the adjusted profit after tax, and this is adjusted only for our one-time or our ESOP costs, which are non-cash costs. So our adjusted PAT is at 64 crores last year. As you know, the company is completely debt-free. Cash balances have gone to over 1,000 crores, which are invested and can be used for the company's growth in the future. So 64 crores is the adjusted PAT. As you know, the company is cash profitable and generating cash in the last year. If we go to slide 4 or slide page 5, I want to first cover the consolidated financial results for the company. which is both for the quarter and for the year. And slide 5 will show you that we've achieved first our highest ever revenues in the last quarter at 106 crores. We've also achieved our highest ever revenues in a year at 358 crores. The 358 crores in revenues have given us in the year 22 has given us a 28% growth in revenue during the year. Our EBITDA, our adjusted EBITDA, which is adjusted for our ESOP costs or a non-cash ESOP cost, is come at 97 crores, which is a 25% increase over the previous year, and also highest ever EBITDA. It's been a challenging year, as I said, for the industry with COVID, semiconductors, etc. But we've been able to achieve the highest ever revenues at 358 crores and adjusted EBITDA at 98 crores. As I once again highlighted in the previous page, our adjusted PAT is 64 crores. And you look at an adjusted EBITDA margin, which is in absence of, or removing the other income, it comes to 21% for the quarter and 16% for the year. So these are rough financial highlights for the quarter and for the year. The one concern I'd like to point out in the consolidated financial results has been some escalation in manpower costs and marketing costs last year in terms of the previous year. But I want to stress here that the manpower costs up by 25% is primarily one because the year prior to COVID, the increments were very low or non-existent, and therefore the increments have been much higher in the last year. So it is almost like a correction in salaries. Marketing costs have, very, very low during the COVID period, and therefore have come back to more normal costs, and therefore it's seeing a huge escalation when compared to the previous year. But on the whole, I would say, the company's foundations just got stronger. We've made a lot of progress by growing at 28%, and profits have grown as well. One of the few internet companies in India which are cash profitable and growing in revenues, and that's probably the highlight. At the bottom there's a footnote about the ESOPs of the company, which talk about a one-time charge, which was there in the last year of 145 crores, and the total ESOP cost 185 crores. As I said, this 145 crores was a one-time charge for FY22. We do not expect this to be in FY23. So I think that itself should tell you about the company performance going forward. Anisha, you want to add anything to this and then take on the standalone and the other financial results?
Sure, Vinay. Thank you so much. So to add to what Vinay said and to clarify, since there has been questions around the ESOP, the approximate cost for FY23 on an annual basis will probably be around 25 to 30 crores, as against the 185 crores that we see in FY22. So this is reiterating that this 185 is a one-time cost, and probably in FY23, the approximate charge that we are likely to see is about 25 to 30 crores. This is on an annual basis. If you move on to the next slide, the slide 6 of the presentation, we have shared the standalone results of CarTrade Tech, which predominantly hosts the consumer group business. These are revenues from our websites like Carwale, CarTrade, and Bikewale, which are media and lead-driven kind of businesses, and also includes Carwale App Shop. We have achieved our ever highest quarterly revenues in the consumer group business, which is about 36 crores in the quarter ended March 2022. And also we have reported a 35% growth year on year on the consumer group business for revenues from operations. The consumer group business continues to report profits if we exclude the ESOP adjustment for the quarter and for the year. The increase in the cost that Vinay has covered in the consolidated set of accounts is also, or rather holds good even for the consumer group business. So we move on to the next slide, which covers the remarketing business, which is represented by the consolidated SAMIL accounts on slide 7. This business includes our commission or transaction revenues, which is predominantly our auction and other related businesses, hosted under the brands Shriram Auto Mall, which is SAMIL, CarTrade Exchange, and Adroit. The revenues for the year was about 205 crores, and the adjusted EBITDA for the year was about 60 crores. This has resulted in an Ebitda margin of 29% with other income and about 24% without other income. For quarter ended March 2022, we reported revenues of 60 crores with close to 20 crores of adjusted EBITDA, which has resulted in a 30% adjusted EBITDA margin excluding the other income. The slide 8 shows the revenue growth of 28% on a year-on-year basis and 15% in Q4FY22 as against Q4 of previous year. The adjusted EBITDA has grown 25% on a year-on-year basis as against 16% in Q4 of this year vis-a-vis last year. The next slide over here displays our non-financial matrix that we have been consistently disclosing. This is our average monthly unique visitors across all our platforms. We continue to attract close to 30 million unique visitors every month, of which more than 84% are organic, which is to reiterate that we pay only for a small portion of our traffic, which is close to 16%. We continue to make investments in customer experience and the product, which enables us to sustain such traffic and enjoy a large organic base. Slide 10 reiterates our dominance as a brand. Over a long period of time, we continue to stay strong at the number one position in both cars and bikes. This is the Google Trends report, which reiterates our high brand recall value, which is because we are as a brand synonymous to trust, quality, and reliability. And we continue to make consistent efforts to improve the customer experience as a platform. On the auction side, if you refer to slide 11, which has been part of the presentation, the listings on a year-on-year basis grew by 43% and by 25% in Q4 of this year as against the previous year. We reached a 1.2 million mark on the number of auctions listed for the year. The volumes for the corresponding period have also grown by 54% annually and about 18% quarterly. If you would please take up the next slide for us.
Sure. Thank you, Anisha. I want to spend a couple of minutes just on the platform and what we're looking to do and what we've done in terms of our key initiatives. Really, this is the platform we're trying to build, and as I've said so in earlier calls and earlier meetings. Look at CarTrade Tech as a platform where on the leftmost side you've got the consumer group, which houses all our consumer brands, Car Wale, Bike Wale, and as we talked about earlier, on these platforms we get 30 million unique customers every month. So one of the strengths of the consumer brand, where people come and buy new cars, used cars, two-wheelers, or sell their cars. We get 30 million customers, and 84% of them come organic. So as I said, the key initiative was to keep growing that business. We monetize, leads and advertising business, for manufacturers and car dealers out there. And we've talked to the standalone financials for that. And then you've got the second block, which is our remarketing business, where you've got our auction businesses. The auctions come from in the various brands of Shriram Automall, Cartridge Exchange, etc. And their supply comes from consumers like you and me who want to sell their vehicle, or come from big business sell their vehicles to businesses. So it's like a C2B, B2B online, offline platform. And that makes up our Shriram Automall business, which is our remarketing business. So these are the two businesses and the two platforms which we run. They're divided into our consolidated accounts, our standalone accounts, and then the remarketing account, which we've already talked about in the last 10 to 15 minutes. Each of these businesses have key initiatives. The consumer group first. On our media business, we've got some key initiatives around our Car Wale App Shop business, which we'll talk through a little later, and a whole digitization of the automobile purchase cycle, which also I'll talk through a bit later. On the remarketing side, we have 2-3 very key initiatives. One is to bring more supply onto the platform, and then that big initiative of bringing suppliers to bring in more and more consumers to come and sell their vehicles, to auction out, and add to this 1.2 million vehicles already auctioned out. Obviously, it also is to bring more buyers on the other side, bringing more and more businesses, dealers, fleet owners, etc., to buy vehicles is another part of the initiative. And then the third block of ours, which is really how we can make strategic acquisition investments in our ecosystem, which is really about making investments or acquisitions in our existing businesses, or really in other areas of synergies where our customers can get some value. So it's about value-added service like auto finance, auto insurance, subscription warranties, subscription financing, warranties, etc. But yeah, the third division is something which is around acquisition investments, where we can make or use the cash we have to really acquire products or services so that our 30 million customers can get access to other products and services. And that's the intent out here. Anisha, I think go to the next slide. Sorry. If you can go to page 13 on the deck for all of you. And really one of our biggest initiatives in the consumer group is really how do we make sure a consumer like you or me can buy a good quality used car a good quality used car online. And what Carvale App Store is provide this to all our consumers. So you can go online today to carvale.com, look for an App Store car. We now are across 47 outlets for all these cars. So you can book it online, get your car delivered, and all these cars come with what we call the Forest Promise, which is really around a warranty, having a money back guarantee of the car. So it's really a solve to making sure or delivering an experience to a consumer which enables him to book a car online and then have it delivered to him or her, and then it comes with this whole Forest Promise of quality assurance, right? So that's what Carvale App Store does. We have 47 outlets today. We are likely to go to 120 outlets by the end of next year, and therefore will become a sizable part of our revenues and our business as we go on. If you go to slide 14, which is really part of our big digital initiative for us, one of the things, the biggest focus or the biggest product focus for the company today is really enabling the journey of buying a vehicle or selling a vehicle in a complete seamless digital manner. What we call in the company a one-click purchase, right? Which enables you to come to a platform to select a vehicle, choose a vehicle. What we want to enable now and what we're enabling and moving towards is you're being able to select a vehicle, book it online, get a loan instantly delivered online to you so that you can get the vehicle delivered to you. So giving you a complete online experience or a one-click approach to buying a vehicle. We've actually launched this finance marketplace some time back where we've got multiple banks giving loans for new cars, used cars, or new two-wheelers. And I think as we go on, this will become a very significant part of our digitization efforts to make sure when you buy a vehicle, you get the loan of your choice in a seamless, simple, easy manner. We wanted to cover this with our financials and our key initiatives. We are happy to go into a detailed question answer session so that we're able to answer all your questions and your doubts. I again want to highlight saying that, listen, in a very, very tough environment of COVID, semiconductor supply issues, etc., we've come out with these growth numbers and profit growth as well as revenue growth. There are very few companies in India which grow revenue and profits and grow them simultaneously. I think we've been able to consistently do that. The company has actually made tremendous progress on the brand itself, brand or revenues or other metrics over the last year. And we'd be happy to present these accounts to you. As I said, now we're happy to go into question answers and clear all your doubts and suggestions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. The first question is from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Thank you for taking my question and congratulations on good set of numbers. My first question is related to the cash which we have on our balance sheet. So we have been maintaining that in our previous con calls as well, wherein we'll go for probably use it for inorganic growth or acquisition. Can you throw some more color on that? As in, what kind of companies you would be looking at to acquire right now? Just for example, I've been looking at something like car mechanics, which is growing really fast in the car mechanic space. So would you be interested in something like that, or there are other plans or other companies also in the other domains which you are looking at? If you can help me.
Sure, okay. Thank you for the question, and what I want to stress on, yes, we are sitting with almost 1,000 crores of liquid assets and liquid funds, on our balance sheet. I think the intent here is that we have these 30 million customers. Most people come to our platform to buy a car or sell a car or a two-wheeler. Our intent is, can we provide an additional product or service to these 30 million customers which come every month? Now, like you said, car servicing is an opportunity for us. We would obviously look at companies in this space, digital or real world companies, and see whether our customers would want to avail of a service or a repair or an accessory or a spare part or insurance or product or a financing product in the future. And that would be the intent, that can we align a product or service to these 30 million customers, and then look at making investments or acquisitions in those companies so that the customer benefits and our experience gets better for the user who is coming onto our platform. And if we can do that, and if we can make or give the customer, one more service or one more value-added service or product, of course, in our automotive ecosystem, then we not only improve customer satisfaction and delight, but we also are able to help the company we made an investment or acquisition on, and obviously able to, they create a synergy value within the company we require to invest in and enough.
Okay. Thank you. Thank you so much. That really helps.
Thank you.
My next question would be regarding the marketing spend. So if we compare our marketing spend with some of our competitors like Car24 or CarDeco, there is a huge gap. So could you throw some light on the philosophy and thought process why we are, when we have the cash in our books, what is our main thesis and understanding why we are spending so less compared to our other competitors?
Yeah, we actually, it's a good question, and our marketing costs over the last 5 years have continuously come down per user and an absolute basis, if you see. And as we showed you, there's a slide on our Google Trends score, which shows our search popularity, where you can see that our search popularity of people searching Carvale versus some of the other brands is so much stronger, and that shows our brand affinity. I think what we've tried to benchmark is our traffic growth, and as you can see, 30 million customers a month come to this platform, these platforms, and 84% come organically. I think one of the reasons why our marketing costs are lower is just our brand affinity and the fact that we can generate such a high volume, 84% of 30 million every month, organically, which we don't have to pay for. I would assume that some of the other platforms don't have this level of organic traffic, and I think that is one of the reasons why their marketing costs are much, much higher. Just so that our brand affinity is just greater. I think that's the simple answer to this question.
Thank you. Thank you so much. And one last question related to SAMIL.
Sure.
In case of SAMIL, where do we see in terms of the digital and the physical auction going right now, and where do we see it in the next 2-3 years? If you can throw some color as to, since I think we acquired SAMIL in 2018, if I'm not wrong, and how has the journey been, where it is right now, and how do we see it in the next 2-3 years directionally?
Sure. Yeah, we did acquire SAMIL in 2018, that is correct. So we think of SAMIL as a digital business. The physical aspect is extremely important and a big differentiation for us. We have 113 auto malls now, and it provides us a tremendous leverage of infrastructure, which of course many of our other players don't have, and gives us a clear differentiation. What we wanted to be is a physical business which has large amounts of digital elements to it, or a digital business, right? Where vehicles can be kept physically with us because vehicles are very physical, and then we can do a complete online sale for these vehicles, and that's what we're looking to implement. Where we see the big advantage of it being a digital business is a big initiative of ours, which is going on, which is really India as one market. You may be aware that GST rules on used vehicles have been simplified, and now if you buy a vehicle from one state to the other, or you bring one vehicle from one state to the other, GST doesn't get incurred again. It makes it viable to be India as one market, right? So typically you could have a vehicle in Mumbai being bid on by a customer in Gujarat, for that matter, or Delhi or any other state, and that gives our digital business a tremendous opportunity, right? So if there are, as I said, 10,000, 15,000 make, model, variants of vehicles in the country, and if there's a particular vehicle being sold in Pune, it's not necessary that in Pune the best price for that vehicle gets fetched. It's possible that a bidder in Coimbatore or Madurai or anywhere in India would bid higher for that vehicle. So the project we're running within, which is really it's a journey for us, and where we think we can dominate the entire used vehicle industry, is if we create India as one market, and the auction is 1.2 million vehicles every year, which we do, and we allow every bidder in India to have access to all that inventory, which we do through our online systems. It gives us a very big differentiated advantage. As you say, India is one market and one-click purchase. That's one of the biggest objectives within the company. So as I said, it's a digital business. We like the physical elements, but the digital elements of that business really differentiate us from everything else.
Yeah. One last request, it's not a question. If you can throw some more detail about our media business, which I believe is an integral part of our business, where we have this business. So if you can throw some more light on the presentation or on the call, if you can throw some more details, that would really help us to understand.
On the media, what was the question on the media business? Is that the question?
Yeah, on the media business. Yeah.
Yeah. So our consumer business is entirely the media business, where we monetize dealers and car manufacturers. It's where the 30 million customers come, and we monetize car manufacturers for advertising and lead generation. It's media business, and we monetize car dealers for lead generation. This is completely as I said, media business. We eat into the media money spent by car manufacturers and car dealers, as the industry report in our RHP showed. About 13-14% of all money spent by manufacturers and dealers are on digital advertising. This is growing and likely to grow in India over the next 4 to 5 years. And really, our revenues come from the digital budgets of car manufacturers and car dealers. As that grows and the car market grows, our revenue there will continue to grow. As we've shown in the standalone accounts, that revenue has grown by 35% last year. So,
right. Okay. Thank you. Thank you so much. I'll come back into the queue if I have any more questions.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to restrict your questions to 2 at a time. Thank you. The next question is from the line of Vijit Jain from Citi. Please go ahead.
Yeah, thank you for the opportunity. Hi, Vinay. So, Vinay, a couple of questions on the remarketing business. So, 4Q is generally seasonally strong for you in the remarketing business, right? And in that context, 2 things look like in the numbers when I see them versus 3Q. There's not a very big growth there. And second, also when I look at YOY remarketing business, it looks like commission per vehicle has declined a bit because the auction volumes are still up 20% odd, but the revenues are down slightly versus that. So that's my first question on the remarketing business. And then I'll just ask my question on the consumer business. Thank you.
Yeah, thank you. So Q on Q revenues from Q3 to Q4 is your question, really.
Yes.
Q3, Q4 tends to be more or less similar. I think the difference really between Q1, Q2, and Q really on one side and Q3, Q4 on the other side. The seasonality is not high, but you got to remember just now as across the businesses, it's been very hard to compare Q on Q because of the COVID impact at various stages, right? I think this year you had Omicron, this in January, February. The previous year you had we had April to July really in this current year itself, COVID. In the previous year, April to June again. So it's just been hard to really look at any quarter on quarter. But the seasonality in this business, there is some seasonality. In Q3, Q4 are better than Q2, Q1 normally. But there's not such acute seasonality. I think that's the first question. What is the second question? Sorry, Vijay, I missed the second one.
Just a general commission income that you're probably generating per vehicle auctioned.
Correct.
That number seems to be going down. Yeah.
That's right. I think what your point is that the volumes have grown at a higher pace than the revenue. The revenue at 20%. I think the volumes have grown by about 40% on. I think the 2 things on that. One is that the ticket size is slightly less. Number 1. Number 2, what's happened is that a lot of because of COVID, we have a physical business, and when we park vehicles physically and then do an online sale, our charges are much higher. When we just do an online sale, our charges are lower in terms of actual revenue. And even though costs are slightly low, but revenues are also slightly lower. And I think with COVID, what's happened is that our actual take rate per vehicle is slightly lower than the previous 2-3 years. And that's because a lot of it went online, just because it was very hard to do the physical aspect of it during this COVID period. So I think that's the impact you're seeing.
Okay, got it. Thanks. My question on the consumer business, Vinay, is the traffic. How should one think about it going forward? Because YOY the traffic number seems to have come off a little bit. And second, so in that context, how are you thinking about the marketing spends here going forward? I know FY21. You were kicking back marketing to normal levels FY22 you were kicking it back to normal levels. So first that, and second on AppSure, do you have at this point any guidance on what kind of volumes you think you will hit once you hit that 120 store run rate, 120 store count by end of FY23?
Sure. The first thing is the traffic part is the traffic is quite stable actually at a 30 million number. 30 million is a huge number. You got to remember the auto industry itself is not growing, right? So So for us to grow traffic in absence of the industry, in fact, the two-wheelers is degrown, dramatic degrowth in the two-wheeler industry. So, somewhere traffic is going to mirror at some point the industry itself, right? I think it's very hard, considering our penetration, right? And digital penetration. No more can we say an auto consumer doesn't go online, right? I think, 80-90% of customers will go online anyway. And then our penetration is quite high. So, I think one thing all of us need is that the auto industry needs to grow, the car industry needs to grow, and the two-wheeler industry needs to grow. I think we had 2-3 years of COVID, and before that something else, and before that something else. So the fact of life, I've shown you a 5-year track record of the industry, it's actually flat to degrown. We've, in spite of that, had reasonable growth over a long period of time. And now things should be stable at 30 million. 30 million is a huge number, by the way, per month this is. This is not per quarter or per year. This is per month, right? So that's the first part. I don't think we're looking at the brand parity is strong, as you showed the Google Trends brand. So we don't need to really increase marketing spend at all. We think marketing costs are stable and should stay stable in the future. I think we shouldn't worry about that. That's the first question. The second was, sorry, I just forget. Sorry, I forget the second.
Sorry. Yeah. So my second question was around AppSure. So you said you will hit 120 stores.
Yeah. So we will go to 120 stores. I think our focus right now is just rolling out across the location. One part of our team is just ramping out. We promised 45 to 50 outlets this year, and we've done that. We want to get to another 75 to 80 outlets in the coming year. And one of our teams just focuses on ramping up and getting sure that every customer in multiple cities, get access to an AppSure vehicle through our online platform, Carwale. And the second part of our team is focused on the operation of the stores, right? How many vehicles, sale per outlet, profitability of the outlet, making sure customer experience is great out there. Cars, the car standard, the quality standard of the cars, and customer experience on owning that car is excellent, etc., the warranty product and all of that, right? At this point, I'm not able to give an average volume per store guidance, but we're focused heavily on making sure the outlets keep growing, let's say healthy and profitable. And as I said, these are franchise-owned outlets. They're run and owned by dealers. We provide the products, the software products of the certification, the brand, the quality checks, the money-back guarantee, the online sale, the technology, the software, and all those tools and products. But basically, the outlets are operated by our franchisees. So for us, it's extremely critical that the franchisee makes money. And of course, we make money because we actually, because of the asset-light model, we make money very quickly, but it's very important the stores have a minimum volume so that the franchisee, is very healthy and makes a lot of money as well.
Sure. Thanks. I'll just jump back into the queue and come back for more questions. Thank you.
Sure.
Thank you. The next question is from the line of Vimal Gohil from Union AMC. Please go ahead.
Yeah, thank you for the opportunity. So my first question is on your standalone margins. Basically, just wanted a clarification on, while you have clarified on the marketing spends, just wanted to know what is causing the other expenses, which is about 8.5 crore. We're running at that run rate per quarter. We were at about 5 crores a quarter run rate last year. So what's leading that? That's my first question. And the second question is on AppSure again. So basically, what kind of take rates are we looking at? Generally, for the used car industry, the take rates are over around 7 to 8%. So since we are in the franchisee model, what are the take rates that we are looking at this point in time? And should we assume similar take rates, going forward as well? Thanks.
Sure. Anish, you want to take the operating, the other cost issue first, I think. Then we can talk about the take rate of AppSure.
Sure. So on the other expenses for the standalone entity, as we pointed out, the quarterly cost is about 8 crores as against the 5 crore. The 5 crore would be average between the two is what will be more realistic going forward. I'm sorry, I missed your name. Vimal. So the 8 crores does have some amount of annual entries that we do pass. Also, there is some amount of listing related or expenses that we did incur post listing, which is appearing in the other expenses. Travel and some of the other expenses have gone up recently, where we have picked up and gone back to our routine businesses. But otherwise, the expenses are just routine in nature, the increase that you see.
So should we then assume this as a normalized rate going forward?
Yes, you could assume that.
And your outlook on margins for the standalone business, what's the aspiration, guidance, whatever you may probably call it? What is it like? I mean, should we still understand this business to be a very a non-linear kind of a business? And where there is a very huge upgrade to margin.
Yes, Anisha, I'll take that. So I think you're absolutely right. I think it's been a tough year for costs, to be honest. And I think especially it's a tough year when you look at the previous year, right? I think because the previous year costs were all-time low. I think there was no travel costs, manpower increments were frozen, and really marketing costs were all-time low. So when you start comparing, 21 and 22, it looks like this. And the fact is also you're absolutely correct. Some of the costs in 22 have gone up, and I think the primary reason for that is product tech talent in the consumer business has been, just with the amount of money or startups getting funded, one of the challenges has been product tech talent and costs related to that. To me, these are now more stable, I would say, and I would think that, this is where it should end up. These are, businesses which have tremendous leverage. So as revenue grows, profitability should grow at a far higher clip. We always like to say that if profit, if revenues grow by X, the profitability should be X into 1.5 at the same rate, right? X into 1.5. But to be honest, this doesn't show it. I'm in FY22, but that's the nature of this business. It is got tremendous leverage around it in terms of increase in revenue and increase in profitability.
Right, because all said and done, we've still grown at a phenomenal 35% rate.
That's right.
I would have assumed to see some margin expansion at 35% growth.
I completely agree with you. And in fact, it's been a tough year for costs, to be honest, just because the base of the previous year has been the challenge, to be honest. It's not so much the actual cost, but it's more the base of the previous year. We feel pretty good that if we had that revenue growth in the future, the profitability should go at a higher rate than that. We feel pretty good about that.
Perfect. And last question would be just to clarify on that take rate.
Yes. So the take rates in AppSure, for us, the used car margins arrive at about 8 to 10% for the dealer. We, depending on the service we provide to the various AppSure dealers, our rate take rates are between 1.5 to 3%. But we have, as I said, it's completely asset-light, so there are very few costs against that.
Perfect. Okay. Thanks a lot, sir, and
Thank you.
All the very best.
Yeah. Thank you.
Thank you. The next question is from the line of Sachin Dixit from JM Financial. Please go ahead.
Thank you. Congratulations on good results.
Thank you. How are you, Sachin? Thank you.
Good. Yeah. So quickly on a couple of things. Basically, my first question is with regards to the appearance of COGS or inventory in your financials. So what does this refer to? Can you elaborate on that, please?
Anisha, you want to clarify?
Sure. So, Sachin, this is in relation to the buy and sell, which is hosted under the AppSure umbrella. There was some portion of our AppSure revenues where we did buy inventory and sell inventory, which is what is appearing in the purchase stock.
It is more a pilot. I don't think we're doing it going forward.
Yes, we're not. It is just a pilot.
We're just piloting a model. It's a pilot. It's a very small amount. So we're just piloting a model.
Okay, understood. Thanks for the clarification. Another question is with regards to the same thing that Demal was asking about. So on the standalone piece, I remember during the last earnings call, you guys mentioned that there is some costs which are on the group level and are being reflected in the standalone piece. So that's why we see relatively lower margin here.
Yes.
So can you please explain roughly where do these margins fall? I believe 5% is still a very low margin for a business of this nature.
That's correct, Sachin. I think what we said was that all our corporate overheads, but that's just corporate overheads, sit in a standalone accounts, and that's what we said. As I said, Shriram Automall and the rest are the subsidiaries which carry their costs, but basic overhead of the company sits out here. So in a way, it goes all to the consumer business. These costs are debited, right, in the standalone accounts. I think that's what we mentioned. I think we continue to maintain that, as revenues out here grow, the margins will grow on a non-linear basis, right? Yeah. If you look at, if you really look at the standalone accounts on its own, the Ebitda margin is 26%. It's when you take up the other income, it comes down to 5%. But we believe that, this is only going to keep growing and get better.
So, just with the clarification on this, so if we try to allocate the corporate cost on both the business, SAMIL as well as this, do we see how should the margins improve in that case? The adjusted EBITDA including other income?
It will change dramatically. It will change. I don't have the exact number, but it will change. But you got to remember, SAMIL is not 100% on subsidiary. So it's not that we can allocate costs there either. So it is done on a standalone. I mean, they are all allocated in standalone cases. I don't have the exact percentages what impact it will make, but of course, these margins, in spite of all the costs being loaded here, and not in Sriram bottom line.
Understood. Thank you.
Thank you. The next question is from the line of Siddharth Behra from Nomura. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, my first question is on the standalone business again. I mean, if I look at the growth trajectory, on a quarter-on-quarter basis, the industry volumes have definitely improved. But in terms of our revenues, the improvement has been more gradual. So is it that the industry recovery on the advertisement side is taking longer, or is there any market share changes which are happening? And what is the outlook from here? How much growth do you see can come through for the industry as such in the next year?
Sorry, was your question that the revenues have grown at 35% in the standalone? That's clear. In the consumer business. So what was the question?
Actually,
was it that the industry is actually?
I was more actually looking the growth maybe on a quarter-on-quarter basis because the COVID impact is not there and the industry volumes are sort of going up. So from that perspective, actually a 6% growth.
Actually, the industry last quarter has degrown by 1%. So I don't know. It's the industry not grown last quarter. So our industry is actually degrown by 1% last quarter. But you know, what I like to explain, you know, just explaining to you, we've grown at 35% for the year. The car industry has actually grown by 11% last year over the previous year. So we've outpaced the car industry growth. I'm actually hoping that, you know, in FY23, the car industry grows at, you know, double digits at least, you know, in FY23. We feel pretty confident that, you know, these growth levels with the industry growing, or the car industry growing at double digits, we feel confident of similar growth rates for the future. Pretty much, I think, in this range, what we feel comfortable with. But I think the important thing is we all, you know, are hoping that we can see a double-digit growth in the car industry, you know, for the next few years, actually.
Understood. And certainly on the cost side, like we have seen costs moving up every quarter. So from here on, from these levels, like you said, that it should be at least on the other expenditure side, should be a sort of number which will sustain. So anything else? How to understand the variable part of the other costs and how much can remain sort of constant going ahead?
Anisha, you want to answer that question?
I'm sorry, I missed that question.
I think it's about other expenses, I think.
Yes, on the standalone side, other expenses.
Yes, so the Q4 would be the benchmark. So that you could assume the Q4 numbers to continue.
Okay. Got it.
There won't be substantial growth from there. There will be hardly any growth on the other expenses. The other expenses typically would include your rent and travel kind of expenses. So the Q4 is a realistic benchmark of the number that you should expect going forward.
Okay, so there is no lumpy costs which have come in the quarter. These are more of steady state trends which should continue.
Yes, mostly.
Okay, thanks.
Thank you. The next question is from the line of Akshay Jagani from Exponent Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. I have a couple of questions. First is that if it will be possible going forward, or rather, can you give us some understanding of the standalone business in the sense that how much cost is related to directly to the advertising piece, or rather the core new car business, and how much is the new project that we have, which is the financing and Akshay, so that we can actually better understand the margins that are coming from the listings business essentially. The reason I ask is globally such platforms deliver 30-40% Ebitda Margin. That's one. Second, I wanted to understand, if I look at SimilarWeb data, the views or visits show a lot higher on your competitor versus yours. But when we see Google Trend data that you put on your presentation, they show a different trend. So can you just sort of help us understand why there is a difference? That's the two questions.
Sure. I think the first question is where we're making investments. We are making two significant investments, which are of course factored in our standalone accounts. One is on digitization, where we have a whole product team, as I said, and teams actually, not even team, working on giving a different customer experience for the future. Now that's an investment which is to me an operating expense because it's investing in our current business, which is really about making sure, when people like you and me come on our platform, today they get a certain quality of service, which is they get to find their car, select their car, choose a car, understand which car to buy, a whole bunch of work. Tomorrow we want them to be able to build technologies and tools so that you can comfortably come, not only find your car and select a car, book a car online, get it financed and disbursed instantly online, or get it, get a resale value for your old car online instantly. So there's lots of technology and products and tools we're building for which we're hiring multiple teams so that we really, and it's really about investing in the next, 2, 3, 5, 10 years for the company, right? For us, it's really our future. These will also bring, as we've talked about earlier, other sources of revenue for us in the future. They're not mature enough, but they will bring financing income or insurance income or booking online income or some transaction income. But those revenues are not accruing today. So there are costs being incurred and investments being made for the future. That's one part of it. We treat that today in our standard accounts as operating expenditure because that's being incurred on a daily, monthly, yearly basis. The second thing is the AppSure part. The AppSure is is part of our used car business, but it's slightly different. It's a franchising business, and there also we are incurring costs today, and the revenues don't compensate those costs. But we are very, very bullish about the future of AppSure because it gives the ability to consumer to sit in his home in one click, buy a used car, and have it delivered to him or her with the complete assurance and trust which it should carry. And these are investments we're making, and as I said, these are all factored in our margins today. So we are investing in the future. Some of the revenues are not accruing and showing here, but they will start coming up in the current FY23 and the years after that. So that's the first part. I'm sorry, guys, forgot the second question. What is the second question?
So I want you to understand the data discrepancy between SimilarWeb views and our trends.
Right. The Google Trends is a brand index which basically says how many people, what's the search popularity of the brand, which means suppose you go to a browser and you put Carvale versus another competitor of ours, how many people put Carvale versus a competitor? So we are far ahead, which shows a brand affinity. I don't know which third-party websites you've seen, but you may be talking about them showing various visits and traffic. So that's a little different. Google Trends is really about popularity of the brand itself, the name Carvale. How many people, and that's a reflection on the 84% organic traffic we get. And the fact that our marketing costs are low, that's one of the reasons why we're profitable versus our competitors. I think that's the difference.
Sure, but just to kind of double click on that, if your brand position or brand popularity is a lot higher, then shouldn't it translate into a lot higher number of visits too?
No, but the traffic, if you see us versus a competitor, I don't know, as I said, which party you look at, but if you look at some of them, they rank us as number one anyway. So I'm not sure which one. And there's some companies that multiple times the traffic. It's not one or two times. It's multiple times the traffic.
Yeah, no, we track it on a monthly basis. So I'm talking about a longer trend than a particular month. One more quick as a follow up. If I see last year to this year on the standalone business, your marketing expenses growth from about 111 odd crores to, essentially it's a 9 crore growth in marketing expense. And revenue growth has been about 29-30 crore on an absolute basis. So incremental marketing spend required to get revenue is almost 1 rupee to get 10 rupees of revenue. How should we see this over the next 2 to 3 years?
I think it's a very good question. I feel marketing costs are reasonably stable, I would say. I think last year was an aberration. If you look at our marketing costs current year, gone back to 2 years back, right? Actually, the marketing costs gone back to pre-COVID levels. Last year, I think it's the same because it was shut for, trade was shut, industry was shut for 3 months. The marketing costs look lower than because of 3 months there was no advertising. I think that's what it was. So I wouldn't read it too much. I would actually just take the current numbers and say, listen, marketing cost is 21 crores on or 19 crores on a revenue of 124 crores, and that's the ratio I would use. That's the better way to look at it. A marketing cost is 20 crores on 124. That's the percentage you should look at.
Sure. Thanks.
Yeah, thank you.
Thank you. The next question is from the line of Devang Mehta from Bay Capital. Please go ahead.
Hi Vinay. Hi Anisha. This is Ravi from Bay Capital. Just one question from my side. The top line growth at 35% growth in the standalone numbers. If you can just talk a bit about what is driving that growth. So is it driven more by OEMs disproportionately spending on digital, or is it because dealers are sending far more business on digital push towards you? If you can just talk a bit more about that, it'll be very useful for us.
Yeah, the growth's coming from actually both sectors. I think the two things which are happening, one is that, of course, there's a little bit more of digital belief among manufacturers and dealers in India. The trade itself is changing, behavior itself is changing because of this whole COVID impact. So, even though the industry is on the whole not grown, digital is growing for them. And I think we're just seeing the first signs of it. This is no means where it will be. I think it will go to fast people or manufacturers and dealers invest far more digital as they go on. As the time goes on. So it's coming on both sides. We feel pretty confident that the dealer side looks a lot more positive in the last quarter. But it's, as I said, both manufacturers and dealers are driving it.
Understood. Second question I just wanted to ask is, the trends that you're showing, which is Carvale and how dominant it is versus others, is that also getting reflected in the business that you're getting versus others?
To be honest, Ravi, businesses are quite different. Cars24, at least some of the other three competitors, are in a very different space of B2C, buying and selling of used cars. I think the only one which is very similar is Car Dekho, which has got a media side to it on the new car side, right? The rest, the businesses are quite different, so it's hard to compare. It's not apples and apples comparison.
If you just compare Carvale and Car Dekho, is that disproportionate, brand advantage is also getting reflected in the kind of media spends that the OEMs or the dealers are doing on your platform versus the other one? Or?
I think it's been reflected in partly that, yes, the media spend and how they spend. Also being reflected in the various profitabilities of the company and the unit economics of the company.
Understood.
Because traffic can be generated by brand affinity or by spending money on advertising too.
Okay.
So I think it's also reflecting the unit economics of both businesses.
Last question from my side is just to understand, last year and year before that, we have seen a lot of issues with the industry. Today, when you look at the industry, what is the issue? Is that there is a demand side issue because the price has gone up significantly once BS6 was enforced, and the insurance cost and everything, so total cost of ownership has gone up, and then of course commodity prices are added to that. And then there was also a supply chain issue. What is the current, in your view, what is the main impediment in front of the industry? Is it demand or is it supply?
In the car industry, it appears at this point, and I say appears for a reason, but it appears because demand is not the issue, supply is an issue, semiconductor or supply chain is an issue. For most manufacturers, it seems to be. It also seems clear that if supply was better or semiconductor was not an issue, sales will be much higher than they are today, the new car sales. But I must caution here that these markets or most markets where if the shortage is 3, 4, 5% gets magnified, and we all believe the shortage is bigger than it actually is. So I'm not very confident that if we had 5% or 7% more supply, this will be the same situation. it may not be a large gap, it just maybe a very minor gap is getting magnified by, and seen by all of us. So I think that's one part of it. I think there are concerns around commodity price increases, price escalation, fuel price increases. All these are real issues for the auto industry. As I said, we are all hopeful that you have a double-digit growth rate in the car industry for the next 3, 4, 5 years consistently. I mean, not 1 year up, 1 year down kind of, which we had for the last 5 years. We are all hoping and believing that will happen. I think the one big pattern which has changed, or two big patterns which have changed. One is that car ownership is on the right. People want to own rather than, then hire a taxi, or that's clearly changed. As you can see that in customer behavior. And the second thing, the customer is definitely more digital savvy, and so the manufacturer and the dealer, which helps us. So I think these are two big changes. But honestly, I would like to see it grow by 10 to 12%. I'm not fully convinced that if the supply was 5 to 10% higher, the demand would exist. I'm not fully convinced, but that is the belief around that the market could sell 10-15% more vehicles if cars were available.
Understood. On the two-wheeler side?
Two-wheeler side, I think price escalation is, I think, the insurance issue. And that's actually one of the challenges, because they're not able to understand fully. Because I think the supply challenges are very, very, they're not supply challenges on the two-wheeler side. It's just sales are down. And I think that's probably a reflection of this demand being down. I think there is some confusion around electric vehicles and IC engines, and consumers are confused of what the future might be here. But generally, it just seems to be that demand is sluggish.
Understood. Thanks, guys. In terms of the industry headwinds, this is a great set of numbers. So congratulations and thank you.
Thank you.
Thank you so much.
Thank you. The next question is from the line of Surya Narayan Manian from DSP Investment Managers. Please go ahead.
Yeah. Hi, Vinay. Hi, Anisha.
Hi, Surya. How are you?
Thanks for the opportunity. I'm good. Thanks. Hope you're doing good. Just one question I had, Vinay, related to the comment that you made earlier to Vijit's question, which is that this 30 million MAUs, I understand this is on a monthly basis, but are you indicating that this kind of traffic is good enough and you can still try and monetize this base better? That's how growth is going to come? Or at the top of the funnel, you will also need more and more users coming to your site, because obviously engagement metrics and sort of viewership metrics, those need to keep going up, right? So from that perspective, I'm just a little concerned that this number is sort of flatlining.
Yeah, it's a good question, Surya. And actually, in our business, we do not monetize all these users. We have something called a fill rate, which means the percentage of the 30 million which we're able to monetize from car manufacturers and car dealers. The limitation for us is not the number of customers. The limitation for us is the amount of money manufacturers and dealers spend digital. That's the limitation. So, without increasing traffic, we could rapidly grow our revenues. It's a simple answer. As manufacturers and dealers' budgets go up on digital advertising, I think that is the point.
Understood. And the other way is obviously if you're able to get them into transacting users and get them to...
That's right. And the other way is to monetize the customers better by alternate methods of transactions, financing, insurance, loans, because the customers, they're both ways. One is monetizing them, just as car manufacturer and dealers better, because we don't monetize all of them. And the second is, of course, adding other sources of revenue to the same customer. Both help, actually, you're right.
Got it. And this may not be such a big trend, but just that in terms of the percentage organic traffic that you're getting, it seems to be, just sequentially coming down a bit over the last 2 to 3 quarters. So is that something that you anticipate will go up, and hence your marketing spend needs to go up, and just in terms of paid?
No, we don't think the marketing costs will go up significantly, but anything this at a 30 million, 84% is very, very high. It's not normal. 88 was very extremely high too. So I think these are minor fluctuations that take place. I would think it will be reasonably stable at these levels.
Okay. Do you have any cutoff in mind before you intervene, or how do you think about that?
Not really. Not really. I don't think we try and worry about it being at 88 or 84 or 85. It doesn't really matter. As I said, about traffic being at 29 and 31, these are very minor fluctuations.
Okay, fine. All right. Okay. Thanks, Vinay.
Thank you.
All the best.
Thank you.
Thank you. The next question is from the line of Nikhil Kale from Axis Capital. Please go ahead.
No, my questions have been answered. Thank you.
Thank you. The next question is from the line of Bhargava from Emkay Global. Please go ahead.
Hi, sir. Are you able to hear me?
Yes, we can hear you.
Yeah. So as you have mentioned that 14% of your of the OEM spends are digital, I just want to know how much of this revenue comes to the auto portals, and maybe what's the market share of Carvale of that spend of those auto portals?
Yeah, so 14%, the total amount spent is about, I think about 6,500-7,000 crores. 14% of that would be about 850 crores a year. Our standard accounts show 123 crores. So, that's the simple answer what Carvale is out of that 850 crores, 123, right? That's one part. Whereas the balance 700 growing is mostly, to be honest, mostly going to horizontals. It's all digital spend. So it could go to any horizontal like a Google, Facebook, or it could go to YouTube, or it could go to, timesofindia.com or any kind of digital asset, horizontal in the country, right? So, but Carvale is 120 out of 840. Anisha, would that be correct? I think that's the arithmetic. That's correct.
Right. Thank you, sir. Thank you, sir. That was helpful.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, it was the last question for today. I now hand the conference over to Mr. Vinay Vinod Sanghi for closing comments.
Yeah, I just want to thank everybody for joining the call. And it's been, for everybody in India, it's quite a challenging year with 2 years of COVID. The industry has gone through a very specific challenge of supply constraints and to semiconductors and other supply chain issues. But we're all on the back. The whole industry is, getting back to normal, and we're really happy that we've had a year where the foundations got stronger. There's been a reasonably robust 28% growth rate in spite of all the market situations. So, we're feeling very confident in the future. And we're very excited that, in the next year we should do a lot more, things to help our customers and consumers as well. Once again, thank you for joining in, and we'll talk again soon. Bye-bye.
Thank you.
Bye.
Thank you. On behalf of CarTrade Tech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.